Hi and welcome to another episode of Monday Market Outlook. Last week we saw some important economic numbers coming out. First, we have the manufacturing PMI. This basically measures the manufacturing activity here in the Philippines, and it is down to 51.4. So it has been 4 months since we are seeing a contraction in the PMI index. Anything below 50 means a contraction in the manufacturing activity. So we're not contracting yet, but we are seeing a significant slowdown. So we might see also a significant slowdown in economic activity for the rest of the year. But the good news, at least, is that inflation has tamed to 6.6%, down from 7.6% last month. But which is expected, because if you're having a slowdown in spending activity and manufacturing activity, it's natural for inflation to also go down. Now let's look at the fiscal expenditures also. It's down from 481 to 468 this year, right? So we're seeing a lot less spending happening for 2023. Now in May 10, agricultural numbers will also be out, and we are expecting either a flat or a contraction in agricultural output, especially with the upcoming El Nino in the second half. But in the meantime, at least, the PSEI is still on a rally. As we mentioned, the breakout from this critical zone here enables the market to challenge its next resistance at 6,740. Now, if it is able to break out of that and confirm this strength, the next level we might be seeing is somewhere around here, 6,840, right? So if we just draw a Fibonacci retracement here, we can see that this resistance level here corresponds to the 0.5 fib, right? And the next level of resistance at the 61 fib stands right here at 6,821 or 24, right? So hopefully we can see further strength in the local markets, and we can see a further upside to 6,820. Now let's look at a couple of issues here. AP still hanging on to its 38 resistance. A breakout of 38, this is not a breakout because it still settled at 38, right? So any breakout there will provide further upside for AP to move towards 40.75, right? Also, we mentioned that Manila Water is a good defensive option for us. So it recently broke out of its trendline resistance here. So if it's able to continue this rally, we are looking at the next resistance at around this point. We are looking at around 21, where it may encounter some sell demand. But we have to be open to the possibility that any pullback for Manila Water will eventually be met by buy demand. So a couple of issues that we were also looking at. Semirara, it was able to bounce off 2690 support, and we are looking at Semirara to head towards 2890, where it will most likely encounter some sell demand. The ideal scenario is for Semirara to form a double bottom here, which opens the possibility of a gap fill, right? DMC also bouncing off support at 980. It's currently at 1008. It might encounter some resistance here at 1035 or 1072. So moving on to the global markets, all eyes were on the FOMC announcement of its rate hikes. As expected, they hiked the federal funds rate by another 25 basis point. And during the press conference, they did communicate that this is most likely the last rate hike, and the Fed may pause at this level for the rest of the year. And the Fed also said that they will continue their policy of quantitative tightening. But if we look at this chart, this is the Fed balance sheet, which tells us a different story. Now, this is quantitative tightening, right? But what is this, right? This is quantitative easing. Understandable, because this is May, right? So this is when the SBB bank collapsed. So the Fed swooped in and provided a lot of liquidity into the markets. So if we look at the S&P 500 versus when the Fed started to ease started to inject assets into the market. This is March, right? So the markets went on a rally. Now, will this rally last given that the Fed has again started its quantitative tightening? Now, on Friday, right after the FOMC report, the non-farm payrolls numbers came out hotter than expected at 253,000. So the expectation was 185,000, and instead there were 253,000 jobs generated. And the employment rate is now at a low of 3.4%, the lowest since 1969. So now this opens up the discussion on whether the Fed may hike rates again in June. No? But if we look at the inflation numbers, the US inflation is now down to 5%. Ideally, you want the federal funds rate to be higher than the inflation rate in order to tame inflation effectively, right? So at 5.25 versus 5% inflation rate, this should be enough for the Fed to pause at that level. We'll see in the coming weeks if we can see more economic numbers that may lead us to believe either the Fed may pause or open itself up for another round of rate hikes. So last 2 weeks, 89% of the S&P 500 companies reporting their earnings, and 79% of those companies were able to beat expectations. Now, talk about setting the bar very low, because for the past few quarters, these companies have been providing bleak forward guidances. Either, oh, we're seeing a contraction in subscribers, we're going to see lesser demands in the coming months because of inflation, blah, blah, blah. We're seeing manufacturing to slow down, blah, blah, blah. But, setting these expectations low opens up the opportunity for them to beat expectations in the coming quarters. So again, the earnings calls for this quarter had very weak guidance from a lot of companies. Are they setting expectations low again for another earnings beat next quarter? If we look at the S&P 500, the index is right where we started at around 4134. If we look at the options for last week, we are right where we're supposed to be at 413, right here. So let's go to the options expirations for next week and see how the market may move in the next 2 weeks, right? So this is May 12, right? So we only have a small amount of options expiring that week, right? But maximum pain is around 409. So there's a significant call wall at 416 and 422. So we might see the market settling down at around 409. But if we look at the third week options expirations, you have here almost 3.5 million options expiring during that week. There's not a strong call wall here, and there's just too many puts in the system, making it hard for the index to go down. So are we looking at the index, right, settling down here at 408, 409, make a move upwards before settling down to 405? Be careful when you're trading the S&P 500 because there's a disconnect between the markets and the fundamentals. Now, if we look at the Fed funds rate futures, here's the Fed funds. This is for September, right? So this is the Fed funds rate futures for September. Look at where it's at. It's at 4.9, right? We are at 5.25, 4.9. This is the Fed funds rate futures for December, right? And it's at 4.42. What this means is that the market is saying that by September, the Fed should have pivoted and cut rates to 4.9. And by December, look, this is a couple of rate cuts already by December. So the market is in a strong disagreement with the Fed. The Fed is saying they will keep the terminal rate 5.25 or even higher until 2024, but the futures markets is saying another thing. Recently, if we look at the S&P 500 and the PSEI, there seems to be a decoupling in the movements of the two markets. So hopefully, whatever downside that we may experience in the S&P 500 should not spoil the current rally that we are having in the PSEI. Thank you very much. That's it for this week. I hope you enjoyed this episode and found it useful. Please like this video, subscribe to the channel, and again, good luck on your trades. Manage your risks accordingly, and I'll see you again next week. Bye-bye.